Let's go to a couple of points I want to get on quickly. Fed week is here. FOMC meeting will be this week. Everybody's been kind of looming in on that July statement, and that is whether or not we're going to see a rate cut. And the biggest case right now, Kalshi along with Polymarket, all well above 95% that there is no change this week in rates, even though we have continued to see pressure from the Trump administration and a lot of his major generals who have been putting pressure on Chair Powell. Let's get into a little bit of what the market thinks is going to happen. Take a look.
A consequential week for the economy, a Fed meeting, tariff deadline, jobs report. It's the busiest week.
Look, it is a very big week. Most economists believe they'll dissent, but we'll see what the Fed does in terms of incorporating that notion that the Fed could cut now, perhaps into the statement, into the outlook for a September cut. Take a quick look at the probabilities. There you go. Fed in play for July. But we also have the probability, 66% for September. And just looking at, I want to do July, 2.1%. It's a really very low probability for July. But then two cuts built in for this year, 67% for September, 63% for December. So the stock market does not seem to be worried about this. There are some economists that are writing about the idea that maybe the stock market is a little bit divorced from the economic outlook. But then again, a lot of this seems driven by the outlook and the hope for tech.
All right, so as you can see there, a few analysts kind of in the camp around July, and I was kind of in that camp as well. I'm still a little skittish on the idea of July, but there are key factors that are in play right now that the Fed is probably considering. It would be interesting if we did get a rate cut, because this would prove Polymarket wrong, because Polymarket's setting us at 98% right now in terms of the probability of no cut. You look at September, that starts to drop down. We just showed this earlier. And then out into October, that one is still at 50-50. So I don't know that it would stretch to December. So could we see a possible September, October, December if we don't get a July? All of this depends on how things play out in inflation. And of course, a lot of that driving that, of course, is whether or not Trump continues to put more pressure. And this, of course, is what's happening right now. He's talking about Powell leaving soon. And sure, of course, he's going to be leaving soon because his term is up next year. I think it's in May. And that is most likely going to be cycling out towards the end of the year anyway, prepping for next generation. And remember, that's how a lot of markets are already playing this, is that, what was it they called it, kind of the shadow chair, that eventually we know that that's going to happen. Market is prepping for that and starting to accommodate accordingly. That's why we're seeing S&P at the rate we are now. Interest rates cuts are coming. Inflation is stabilizing near target. Time is ticking, and the Fed needs to stop being late. If you look at true inflation right now, again, back down to 2% after we clipped up a little bit and dropped down to as far as 1.66 there on July 9th. So still stabilized. If you look at really where we've been since March, let's just cruise in here at 2.1% on February. This, of course, was after that full-on decline right there at the top of the peak right there, if I can get to it. Okay, at 3.1, and that, of course, was back in December. So it has been a consistent decline down, stabilizing with the market, even with a lot of these trade deals that have been in place. Let's go over to a couple of other things that I want to showcase here today, because one of the things is if you look at the market in performance-wise after Fed cuts. Well, here's the example right there. Let me kind of zoom in on that for you guys. 1973, 1980, 82, and then all the way up to 98 in 2019. But the key here is it's been averaging around 5% on a 6-month and a 1 year, with some of the years performing excellently. If you look at 1982, that was the one after one of the biggest market crashes ever. 36% after the first year. That was a big return. Where we are trading right now, I don't know if that necessarily is going to see those kind of numbers. I think we're probably somewhere in that 5% range, which is still very good for an S&P. Where I think you'll see a lot of the move is going to be in risk markets. Here's James Fishback. He is continuing to put some pressure on this. Remember, this is the Doge guy. Trying to put some pressure, and this is Azoria versus Powell and the Fed, and they're trying to basically get access to these meetings that are happening prior to the announcement, when they, kind of air that there's no rate cut or there's going to be a rate cut, and they want access. And I think this is something that is more of grandstanding. We'll see how it goes, but here he is talking about. Take a look.
If Jerome Powell is not being political, they have a meeting coming up next week, right, Jackie? Mm-hmm. Open that meeting up to the public. That's my challenge to Jerome Powell. If you're not being a political panicking, then open that meeting up so we can all see. If you're actually deciding rates on the merits, on the economic facts and realities, then let's see the meeting. The problem is the Fed is contravening transparency law by keeping these meetings closed to the public. And so it's no wonder that the president and so many others, myself included, are rightly frustrated. We have no idea what is actually going into the Fed's thinking.
Don't you worry, though, if you open those meetings up, then you'd open yourself up to lobbyists, because then you're basically telling the other sides exactly which Fed governor thinks one way, who do you have to work on? I mean, isn't there some value to having the opacity to that meeting?
I don't think there's ever value to shying away from transparency, right? I'm glad that Congress is open to the public, our courts are. My challenge to Jerome Powell is, if you are a good man, if you're doing the right thing, open that meeting up. Otherwise, you're hiding something.
All right, so a lot of grandstanding. We've seen this guy before. A lot of grandstanding. I would, he's kind of interesting, crazy kind of person. But I would agree with the analyst there, is that opening this up is not necessarily the best thing for the markets. And done the way it is, which is in private meetings where they're basically negotiating a lot of this, it definitely would start to move the markets. Very interestingly, if you started to see that kind of transparency, I just don't think it's going to happen. Much like you don't open up, national security meetings, you don't open up meetings that have real effect on all these exterior markets. All right, so what is happening, though, is trade deals. And, of course, here is the statement right here. Trump, of course, says the U.S. has reached a trade deal with the EU. Some of the things that the deal includes: agreement on zero tariffs on the open trade side, EU to buy up to $750 billion of U.S. energy. I think there's also some defense deals in there. EU to purchase vast amounts of U.S. automotive. We'll see how that goes. Tariffs also on automobiles reduced to 15%. This is going to be interesting because it's 15% from us going to them and 15% from them going to us. So that is, kind of equals out. But the point is, how is this going to affect inflation? I know there's a lot of people out there that this affects a lot of industries, including the beverage industry, wine, liquor, et cetera. It's going to affect certain luxury items, especially in the automotive category. You could see Mercedes, Porsche, BMW, all those starting to play into this. This is going to get interesting. We'll see how it plays. Of course, right here was his statement that he announced the trade deal. All goods over $600 billion in 2024 imported to the U.S. will be hit now with a 15% tariff. So there you go. Another awful deal that drives up inflation is what people are saying. I'm kind of on the fence of whether or not this actually happens. Key here is, remember that these companies and international clients want access to the biggest market in the world for them. You have to remember, the United States, for most countries, is the biggest market in the world for them. So I think they're probably going to do some deals to be more competitive, still deal with the tariffs, because they've been fielding those for quite some time where they haven't paid them and have continued to basically gig the American economy for those kind of prices. So we'll see how it plays out. Other things, buy now, pay later. This is not a good sign. Transaction volume is expected to reach record high at $116.7 billion. This is 2025. Remember, this is going to be double the 22 time. Now, remember, I will say this, though, that in 22, there were very few buy now, pay later programs. And I think it's just the proliferation of Klarna and many of the companies that are doing this. Almost every e-commerce platform out there offers this now. So it may just be more of a cycle that has been more exposure to this. If it is, in fact, the fact that people want that instead, maybe they're doing buy now, pay later and they're repositioning that cash into investments. You don't know those kind of things. That is a high number, and you can kind of see the chart right there. But they are piling on debt like never before. Dave Ramsey would definitely not like that, but Robert Kiyosaki would. All right, so here, of course, is news on ETH trying to break the 4K wall. Right now, people are kind of looking at this and say, maybe this time is a little different. It tried this 3 different times in 2024. That was back in February 2024, and it failed. But remember, still a lot of pressure on the regulatory front. That's gone. Most likely, if the only thing that would possibly slow it down is if we don't get a market structure bill through. I still think we will get a market structure bill through, and maybe the market is forecasting that. The other thing that plays into this is the fact that we are now seeing Treasury companies play out strategically in open Wall Street. All of this is very positive for ETH, and I think it's just a matter. The minute it goes through 4K, I think it is the maybe the next potential parabolic move for ETH. Capital rotation playbook right now. People are, TradFi is deploying into ETH, ETFs, plus Treasury buys. And then native crypto is stacking infrastructure power through validators, which I agree. A lot of people are starting to raise money for ETH, and Jupiter is also now the 7th largest Solana validator. So different venues, but it's all the same game. I would agree with this tweet. That's a good analysis of it. I want to go to a clip real quick because this is Pompliano talking about Bitcoin, and we'll explain a little bit more about this, but watch this clip.
Having a lot of people on to talk about stable coins.
Yeah, well, the nice thing about stable coins is they don't go anywhere other than stay at $1. So, they can grow in market cap size in terms of how many people are using them. But I don't think people really use stable coins as a comparison to Bitcoin or altcoins where they're looking to try to drive some sort of financial performance.
What's the next big thing to move Bitcoin higher, what do you think? Because it seems like you've gotten everything you wanted, haven't you, at this point?
Oh, there's still a lot more that we're looking for.
What do you
The United States government at some point is going to announce that they're buying Bitcoin.
All right, so a couple of points that Anthony was making there. I think the biggest challenge is still the rotation. Remember, markets move with consistency, how markets move, and that is in most cases looking at other investment opportunities as things cycle through, natural evolution of how markets work. If you look at the Bitcoin ETF, here's a good example, continuing to decline there, as you can see in the chart, all the way from its high, and this was back on July 10th. So it's been slowly ticking down sideways on the price. Dominance is dropping. And then, of course, you flip over to ETH, and we are starting to see slowly ticking up. And we have not seen a real parabolic move like what we have seen with Bitcoin ETFs. So I think this is the cycle now where Bitcoin is finally starting to adjust, more of a sideways association of how the market will play. And ETH is now the game. And this is including institutional capital. And I think we'll continue to see more innovation coming out of treasury companies. So all of this playing in ETH's benefit. Here, of course, is Scott Melker talking about, I hate to even think this, but I'm a huge fan of Bitcoin treasury companies, but raising debt to buy Bitcoin could be the next bubble. I mean, you have to think about this because this is exactly what Saylor has been doing for years, and he's in good position. Now, could these companies maybe start to leverage DeFi? Yeah. And maybe start some earnings on that. That would be the strategy, I think, that a lot of companies should be looking at, and that is other revenue sources, because that's what's happening right now with the ETH treasury companies. They're looking at other revenue sources, and that is what will solidify these markets going forward. And I think Bitcoiners need to just wake up to that. Yes, they do need DeFi, and yes, they need altcoins. The ESH coins are going to be needed to be able to see those kinds of innovation points, even around Bitcoin going forward. Other points I want to get at, ETH is a much better treasury asset. This is a good explanation of it. A rock that collects dust while you custody it with Coinbase. Even though if that is now starting to get deployed into DeFi or something of that nature, now you start earning. I like that. You could also start lending against it, putting that asset to work. There's so many different ways that some of these companies could really deploy some strategies around this. And I anticipate this will happen. So it's just a matter of time. Here, of course, is Hunter Horsley talking about, and I agree with this statement right here, is that the iPhone launch within just a few years, every business, mobile app, mobile strategy, everybody was on it, right? You guys remember that. I remember people fighting it so much from a BlackBerry crowd and the crappy crowd of, next generation phones that they thought. I remember it was Nokia and, what was the other telecom out of Germany that thought they were going to just explode. No, it was the iPhone. And I think that's where we are right now with the Genius Act, and it's all coming into, in most cases, Ethereum and a handful of other strategically positioned digital assets that are going to grow with that. So get ready, guys. We're going to see some new players in the market. I want to play one more clip for you. This, of course, is Matt Hogan and Jeff Seyffart. Let me say this again. It's Seyffart. All right, I want to play one more clip for you guys. This is Matt Hogan and Jeff Seyffart from Bloomberg talking about four-year cycles. Take a look.
I think I'm somebody that thinks it will be intact, but it's going to be muted. I mean, if you look at it, I think those loops are kind of getting smaller. Like, I don't know if we'll see like an 80% pullback. Could we see 50? Maybe something along those lines.
James and I agree on one thing and disagree on the other. Sad fact for me, but a fun fact for you, is the average Bitwise client allocates after 8 meetings. And if they started doing quarterly meetings when the Bitcoin ETF launched, they finished that run at the end of this year and start allocating in 2026. These people just move slower than crypto retail is used to. And so I think we'll set a new record for flows this year. I think we'll set a new record for flows next year, and so on. My thesis is that the factors that have driven the 4-year cycle, there are really 3 that people point to. One is the Bitcoin halving, one is interest rates, and one is blowups. Some combination of these things, interest rates and macro conditions. But the halving is half as important every 4 years, just statistically. Interest rates are as liable to go down as they are to go up. They went up aggressively in 2022 and up in 2018. And I think the risk of blowups is dramatically lower now that we have ETFs and regulation. So my money says 2026 is a pretty good year. Could be volatile. There could be pullbacks, of course. But I think we're going to go up in 2026 and break the 4-year cycle.
I'm going to go with Matt on that one. If I was trying to choose a side, I'm kind of in the same camp. I would agree with all his points. The blow-up's very limited. Granted, there's always black swan events, but that's you kind of have to throw those out. The issue with what we're going to see with interest rates, it's going to happen. Yes, it's going to be dropping next year. I think the other factor that goes into this is who are going to be the big winners going forward. And that's where I think we are going to see a lot of these digital assets outside of the Bitcoin layer. And that's going to be projects like Solana, Avalanche, obviously Ethereum, what you may see with XRP. Many of these, including Cardano, there's so many that most likely we'll see more edging up in later this year and into 2026. I think it's all about positioning where you guys are going. Let me know what you guys think. Drop some comments down below. And of course, join our Diamond Circle. We have a big news for you. We're getting ready to launch a new site. A lot of new services, a lot of new cool things that we're going to be doing over there. But all you have to do is join that club right there. Use the link down below. And of course, follow me on X @Paul Barron. We'll catch you next time right here on The Paul Barron Show.